Well, hello everyone, good morning and welcome to another edition of the Money Garden. Today it's Monday and it's Money Monday. We talk about business. And by the way, before I move forward, I want to say happy belated Mother's Day to everyone. This is the Monday right after Mother's Day weekend, and I hope everybody had a really fun Mother's Day weekend. So with that said, today we're going to go ahead and talk a little bit about the different types of retirement accounts. Through my conversations with people, I started realizing that oftentimes people are actually majority of people are very confused over what are the different types of retirement account. And in interest of time today, I'm not going to go into too much detail into any of these, but I will cover just high level overall basics of what you need to know about different retirement accounts and the different types. So what I'd like you guys to remember is, first and foremost, there's two major categories of retirement accounts, the way they are categorized, and that is from a taxation perspective. On taxation, there is something called the pre-tax, meaning you contribute money to these accounts from your income before you pay taxes. So you're not going to pay taxes. So if you make $100 a year and you want to take $10 and contribute to a retirement fund or retirement account, then you're not going to have to pay taxes on it this year. You will pay taxes on it at the end, which is a whole other conversation for a different day. But for right now, all you need to remember, there is a pre-tax, so you're not going to have to pay taxes on that amount this year. And then there's something called after-tax. So what are the different types of accounts? There is something called 401k, which is probably the most popular, or most people, either if you work for a corporation or a business, you are likely to have a 401k account. And even if people don't have one, but majority of people have heard about it. So there's a 401k, a 403b or 457 is exactly the same thing as a 401k, except it's different IRS codes based on whether you're a police officer or a teacher. It's just different IRS codes based on these different professions, but they all mechanically work the same way. They have the same eligibility requirements and the same factors involved. And then you have something called IRA, which is an individual retirement account, or a SEP IRA, which is a self-employed individual retirement account, if you don't have a 401k through a corporation. And then the after-tax is your Roth IRA. As you can see, there's only one account that you can contribute to for retirement with after-tax dollars. Now, what are some of the differences, and just the high level how these different accounts differ is based on your contribution. Based on whether you're 50 or over, then you are allowed a little extra for catch-up. Based on your distribution, meaning when you get to take the money out. Based on your RMD, or otherwise known as required minimum distribution. And based on eligibility altogether. So let's go over these very quickly, okay? Again, remember the two major categories. One is pre-tax, one is after-tax, right? The pre-tax, you will find all of them pretty much, which are your 401k, again 403b, 457, your IRA, and your SEP IRA, which is a self-employed individual retirement account. And you will have your Roth IRA, which is after-tax dollar. From a contribution perspective, on all your on the pre-tax 401k, 403b, 457, you will be allowed $19,000 a year maximum. If you have an IRA or SEP IRA, you're allowed 25% maximum, 25% of your income, or $56,000, not to exceed $56,000 a year. If you have a Roth IRA, you are allowed up to $6,000. And I should mention that all of these requirements and the eligibility factors, they are valid for this year, 2019. The IRS sometimes keeps them the same, sometimes changes them year to year. The amounts go up or down. So just keep in mind everything I mentioned, all these are valid for 2019. Last year they were slightly different, next year they might change. But this year, this is what you can expect. So contribution, again, $19,000 for all the 401k, 403b, 457, and 25% maximum, or $56,000 for the IRA or SEP IRA if you're self-employed, and then $6,000 if you have a Roth IRA. Now, if you have a 401k and you're not maxing out your 401k, you can have a 401k and a Roth IRA if you fall within the eligibility requirements. if you're over 50 or the catch-up period, if you're over 50 for your 401k, 403b, 457, you're allowed an extra $6,000 to contribute a year. If you have a Roth IRA and over 50, you're allowed an extra $1,000. So altogether $7,000 a year. Distribution. You cannot take money out until you're 59 and a half for all of them, except on a Roth IRA, you can take up to your contribution because technically you already paid taxes on that, you guys. So the government allows you, you have access to that money anytime you want. So over 20 years, if you put in $5,000 every year, you can take anytime. No penalties, no taxes on that money because you've already paid your taxes. What you cannot take is anything under growth. So let's say you have $5,000 a year, you have a 10% rate of return, you made $500 on that $5,000. Up to that $5,000, you can take the money out, but you cannot touch that $500, which is your growth, until you're 59 and a half. So that portion works exactly the same as any other retirement account, which is 59 and a half, when you can start taking money out for retirement. RMD, or required minimum distribution, that's 70 and a half. And that's again the same way like all of them, you guys. So if you're over 59 and a half, you can start taking money out. But if you haven't taken anything and you're coming up to 70 and a half, you have to take your money out. Otherwise, the government will tax you up to 50% and will take a lot more out of that money than otherwise you would pay. So please keep in mind, remember, if you're 70 and a half and you have a retirement account and you haven't taken all your money out, you have to start taking money out. And then finally, the eligibility. For the pre-tax, everyone is eligible, irrelevant of income. For the after-tax, you can technically, if you're a single person, you cannot make more than $122,000. So if you make less, 122 or less, or 193 if you're a married couple and you file jointly, then you're considered middle class, and the Roth IRA is specifically designed for middle class people. So I know that seems like a little bit of too much information, but these are the basics for 401k for your retirement funds. And again, if you can just remember one thing, or you can take away one thing today, I want you to take away there is pre-tax and after-tax. This means how you contribute to that fund. And all of your funds, everything fall under pre-tax, and under after-tax there's only one, and that's a Roth IRA, and only that's designed specifically for middle-class people, and there is eligibility requirements on that. So hope that helped you guys today. Hope that shed a little bit extra light on the wilderness, so to speak, of different retirement accounts. And as always, please let me know your questions, your comments. I'm always very curious to know your thoughts. And thank you so much for joining us, and I will see you guys Wednesday.